Hey, I think we're live.
I think that we were live when we were already talking to each other.
A little bit, but
I
that's
mean,
that's
we've
okay.
we've been in conversations before where it's not recorded in front of other people,
Yeah,
so it wasn't that
yeah.
strange for me.
Thank God
Was it hard for
it
you?
wasn't recording all of our conversations.
How do you feel about recording conversations on Zoom
I
and Teams?
I uh I am willing to overlook the discomfort for the value that it adds.
Oh, interesting.
Yeah,
I think I'm in a different place on
yeah. Shocking.
that. Shocking.
Well, hey everybody, welcome to the Atlas Investor and Resident webinar. We're excited to have you with us today, and we've got 45 minutes where we're going to talk about investment real estate and the Atlas investment thesis. And we actually have a couple of slides, and I think you're able to see them on your screen right now. We'll share these slides with you, and then we'll just kind of turn those off, and we'll have some dialogue around investing in residential real estate. Sound good?
I think it sounds great to me.
Cool.
Are we jumping right in?
I think we give it just another minute. I can see a lot of people are still joining. And so we'll give it another minute before we dive into our content.
Okay, that sounds pretty good.
Should we just sit here in awkward silence until we start?
I think that the banter is overrated. You know, like a lot of podcasts these days, there's like banter for like 10 minutes before the actual content.
Yeah.
Yeah, so I'm kind of bad on the banter piece.
What about 10 minutes of ads before the actual content?
Oh, that's a good idea. So, sponsoring our show today is Atlas Real Estate.
Yeah.
A full-service, vertically integrated property management, brokerage, construction and maintenance, and joint venture operator in 8 states in the western United States, focused on supply and demand, meaning that we only invest into supply-constrained markets with outsized demand. Atlas Real Estate. You can find us at realatlas.com, at Instagram.com, which I've never heard of.
Wow.
All right.
There was actually some decent content in that.
Yeah, there was some BS too.
Sorry.
Yeah.
All right, well, let's dive right in. So welcome again to the Atlas Investor and Resident webinar. So we do an investor webinar regularly, and we included an invitation to our current residents for this one as well. And we're going to talk about a couple of important things. So first of all, your presenters, not an important slide. But we do want to talk about this. This is our mission statement at Atlas. We are here to uplift humanity through real estate. And what does that mean? Well, when we talk about it internally, the first thing we talk about is our team members, because we do employ 150 people in our company, give or take, and our commitment is first to them, and that we create an amazing place where they can work and do amazing work for the people that we serve. So what we found is when we have amazing team members and those team members are engaged and happy, they deliver great results for the owners that we serve and all the residents we serve.
That's right. You're going to wake up every day and spend 80% of your waking hours going to work. You've got a pretty miserable life if you're not enjoying that. So let's make sure that we all enjoy what we get up and do every day.
Yeah, it's a big deal to us. So uplifting humanity through real estate then moves from our team members to the owners that we serve by managing real estate for them, and the residents who live in that real estate. And a big piece of that is empowering residents with education and tools to navigate a home buying journey and hopefully eventually become investors themselves.
That's right.
And from that, we really wanted to make sure that as we talk about that, we're always talking about it as a win-win for both the owners of the real estate and the residents who reside there. And what's fun for us is we, over the last, 3.5, 4 years, we've started to prove out this theory. This was a theory 4 years ago, 5 years ago.
Oh.
But what have we found, Ryan?
Well, let me ask you a question first.
Great.
What is the greatest cost of owning real estate?
The single greatest cost of owning real estate is vacancy.
Vacancy.
Yeah.
And so if I'm protecting against vacancy, then I should really focus on my customer. And who's my customer in this situation?
Well, we talk about this a lot internally. The only person who actually writes a check to Atlas is the resident.
That's right. And so if I'm providing exceptional customer service to the resident, then they're more likely to renew their lease.
That's right.
And when they renew their lease, how does that serve the owner?
Well, a renewal means I don't have vacancy, number one. And number two, I don't have turnover costs. So I'm not paying to paint the unit and change out the carpet or whatever happens at a vacancy, those turnover costs, and we've all seen it over the last 5 years, have been wildly impacted by inflation.
That's right. And so when I treat the resident with dignity and respect, and I take care of their maintenance issues as quick as I can, I listen to their other needs, they don't have the cost of moving and the headache of moving. They can establish home and community. They feel like they have that respect in a more broad fashion, and all those things mean that we protect against our greatest cost, which is vacancy.
That's right.
Yeah.
So we've created, and we've actually got some data around this. The data is still improving, that when we work with residents to help them become a homeowner, they tend to stay longer in that property. They renew more often. They leave the home in better condition when they do depart. So we're reducing turnover and vacancy costs, which is just a win for our owners across the board.
That's right.
Yeah. Really cool. In the last year, in 2024, when we first fully implemented this with our residents, we helped 15 residents purchase a home through Atlas.
That's right.
And the beauty of that, as an owner, I own real estate, Ryan owns real estate, everyone on our executive team owns real estate. In fact, this is a fun metric we don't share very often. One of the metrics we measure internally is how many doors are owned per team member.
Yeah.
And that's unique to Atlas. How many property managers actually own real estate and actually understand how to manage it from the perspective of an owner? They've had a vacancy. They've had to pay for a turn. They really think about managing differently. And our number, I think right now, is around 2.4 doors owned per team member at Atlas.
It's pretty incredible.
It's pretty incredible.
The average person owns more than 2 doors of investment real estate, which the fun part about this for me, and the reason why we do this company, is because those people are able to say, you know what, down the road, I'm going to be financially secure.
That's right.
We have an issue in our country that we're not saving enough money for retirement down the road, and the folks that are working with Atlas as employees will one day be financially secure.
Yeah, and our hope I'll go to our next slide here actually. Our hope in the Atlas Uplift program, and what we call this kind of uplift cycle, is that we get to expand that impact even more broadly to not just the owners of residential real estate who we serve today, but that renter becoming a homeowner, right? Then potentially becoming an investor, needs another renter, and we just repeat this cycle. And every renter who moves to homeowner, we know we're changing their financial future.
That's right. I think we're changing their financial future, and I also hope that we're changing their perspective on what it is to deal with a property manager that cares for their needs. Look, folks, this is at the core of who we are. We've had a lot of questions on this from many constituents over the years. Hey, you're taking my renter, you're turning them into a homeowner. That's bad for me because they're paying my rent. That's a very narrow and scarcity mindset to look at this. And we're really excited because the data is beginning to demonstrate the thesis that when you treat people right, all people are winning. And so we welcome more question and more thought on this, but this is at the core of who we are.
Yeah, and I remember when we started this conversation, Ryan, 6 years ago.
Yeah.
We were so intentional about this. It took us 3 years, 4
That's
years.
Right. That's
to
right.
actually formulate the concept and roll it out and be really confident that it could be a win-win.
That's right, and it has. It's saved on tenant turn, it's saved on vacancy, and frankly, our mission is not just to deliver on real estate. Our mission is to make the world a better place.
Yeah, that's right.
And I want to also offer just a good juncture to do it. We've already gone through a lot, and I think we're about to jump into the primary reason for this webinar. But if anything that we've brought up has brought a question in your mind, please hit the question, the Q&A at the top of the screen. Throw that in there. We'll be looking at that, and we want to answer any questions that you guys might have, not only on who we are and our mission, Uplift Humanity, but also on the Atlas investment thesis, which we're about to jump into.
Yeah, so Q&A, please start throwing those questions in the Q&A, and we'll try to tackle all of them that we can. All right, so let's jump over to this Atlas investment thesis. Now, I think maybe some history is a good place to start.
Okay.
You okay with that?
Yeah, history's good.
Ryan, tell us a little bit about the first property that you bought.
Yeah. Well, let's see here. I was 25 years old. It was 2005. And I was renting, and I realized that in renting, I probably wasn't doing much for my long-term financial future. And at that time, I was making a little bit of money. I was employed, but I didn't make enough money to get qualified for a loan to purchase a property. I didn't have the down payment to make that down payment to purchase that first property. And fortunately, I did have credit, but not a lot of it. It was good enough credit score. Those are kind of the three things you need to buy a home: down payment, the income, and the credit. And so I had this crazy idea that I would turn to my parents and say, hey, Mom and Dad, will you please co-sign on a purchase? And after co-signing, can I also borrow $10,000 for the down payment? And they said, go fly a kite. You're 25 years old. You're an idiot. And I said, hey, I actually think that I can buy this home. And my current rent payment at the time was about $400 a month. And it's crazy. I was renting a room for $400 a month. And I said, I think I can buy a 3-bedroom, 2-bath house. And I bought that home in the Five Points neighborhood. And it had the 3 beds. And I said, I think that my rent will go down. I'm going to rent 2 of the rooms for $400 to 2 friends. I'm going to have the 3rd room. And the mortgage on this property is going to be about $1,000 a month. And so I went ahead and I bought that property. That worked for me. They said, hey, we don't believe you. And I said, trust me. I ended up paying $200 a month, so my rent cost went down. And then 2 years later, the home value went down. Because 2 years later, in 2007 and 2008, we had the great financial collapse, the crisis that we saw with the subprime mortgage collapse. And a home that I had bought for $175,000 went down to probably a value of about $50,000 or $75,000. But I still had it rented to 2 friends, and I was still only paying $200 a month. And eventually I decided that I wanted to go buy another home, and I bought the next home, and I rented out the first one to a family. And I then did that over and over and over again to build more real estate. But that first home that I bought, I still own today. And it started at $175,000 in value, went down to 75, and it took about 10 years. But then it came back up, and today it might be worth $600,000 or $700,000. I don't know. And my mortgage is gone today, and it might rent out today for 25 or 28 or $3,000 a month. And so I got kicked in the mouth, but it was a story for me of the value of investing for the long term and the value of being able to pay my bills with the rents. We'll call that cash flow. And that began to mold the Atlas investment thesis. And we'll get into the specific ingredients in a moment, but I think that's what you're asking me.
Yeah, and I think it's just such a great story. Starting with, a renter.
Yeah.
At 20-something years old, right, who clawed his way through college. You did graduate, right?
I did graduate.
Okay, good.
It's
good
the
job.
only credential.
Good job.
It's Ryan Boykin. There's no credentials afterwards. I don't have the MBA,
no letters,
the doctor,
yeah,
any of those kinds of things. It just ends. Yeah.
And but I think the story oftentimes the assumption is when you look at someone who owns real estate today that they somehow lucked into it, they inherited it. It wasn't your trust fund that helped you buy your first house.
Yeah.
It was working out with your parents a way to get them to co-sign and make this thing happen. And from there, you house hacked.
That's right.
That's the term that's been coined since then. You didn't know it was house hacking at the time.
That's right.
You just thought it was a great side hustle to rent out a few rooms.
That's right.
And fast forward to today, and it looks pretty incredible.
And look, I still had an advantage. And I don't want to skip over that. My advantage was that I had 2 parents that were willing to co-sign.
Yeah, that's right.
And they also put up the $10,000. By the way, I gave them half the property too.
That's right.
So that their $10,000 has turned into about $350,000. It was a great investment for them, right? But I did have that advantage, and it got me in the game. And that's not always the case. Sometimes we have to think of other ways. But when you're buying your first home, some people think, I don't have income, I don't have down payment, I don't have credit, I can't do it. I think that our thought process on that is, how do we get to yes? Maybe you have 2 of those 3 things, and we help you figure out the third. Maybe you have one of them, we help you figure out the other 2 to 3. Maybe it's going to take you 2-3 years.
Yeah.
But having that goal out there, I think I had that goal and I aggressively pursued it.
I think the other thing you did, Ryan, was, and I don't know how intentional this was, so you can comment on that. You didn't buy your dream house.
I bought a house in a pretty rough part of town. The reason why I was able to buy the house is because the former owner had found a weapon in the alley, and the next day somebody came looking for that weapon, and it scared the former owner, and they put the house on the market. Now I was on the fringe of the fringe. If you think about 2005 and 5 Points, but I was also thinking into the future of what I thought that area may become.
Right.
And so there was a forward-looking attitude. I wasn't buying in, at that point, downtown Denver, which was main and main in terms of the best real estate.
Yeah. Yeah. And you were buying, so you were thinking a little bit about what's it going to look like 10 years from now.
Correct.
But you're also thinking about, hey, this is a place that's affordable enough. I can put a couple roommates in it. But I'm guessing it didn't have like really nice granite countertops and
Correct.
and high-end finishes.
Correct. Yeah.
Right. So you were willing to take a little bit of short-term, maybe dissatisfaction
That's
for
right.
long-term satisfaction.
Yeah. Long-term being the operative word there.
Yeah, that's
Yeah.
right. Well, I think with that, maybe we jump into the investment thesis that was kind of born out of that experience.
I think it was born out of it. It's a little bit simple or Pollyannish to think that that one experience crafted this investment thesis. We've then gone on to at Atlas, we've probably purchased pretty close to 10,000 homes over the years under this thesis. So this thesis has been molded and sculpted and pushed and pulled on, and we revisit it annually probably to make sure that it still holds up. And I'm sure people are asking, well, in 2008 it held up, and this is a totally different time period. That's part of any thesis. It's a living, breathing entity that takes into account the overall market, the submarkets, the people involved with it, as well as your goals. And I'd say that the biggest element of the Atlas investment thesis is long term. And so why don't we show them the first item?
Yeah, for sure. So number one, 20-year long-term vision for buy and hold.
Yeah.
When you first started investing in real estate, so you made this purchase as a place to live, but when you first started investing in real estate, were you a buy and hold person?
I don't think I was smart enough to know I was a buy and hold person. In fact, I think that most of the world talks about real estate, and it kind of fits in the get rich quick bucket.
Yeah.
You jump on YouTube and you hear somebody talk about it. And I always tell people when we're talking about Atlas, if you want the get rich quick vehicle, we're not the one.
Yeah.
And I probably wanted to get rich quick when I was 25 years old. And I discovered two things. One, there was way too much risk in every get rich quick scheme for real estate for me to understand and get my arms around. And two, and this is a personal discovery, everything that I enjoy in my life is also long-term. And the financial considerations are also long-term. So I always see the value in the long-term. I always try to find those long-term solutions. I know that that's what we do at Atlas daily, but it's not the get-rich-quick scheme.
Yeah, so this kind of concept of begin with the end in mind, right? Think about what do you really want this to look like at the end of the day.
That's right.
And that's a long-term perspective. So talk about why 20 years as a long-term vision kind of is where we landed.
Yeah. I think that the easiest way to look at this is looking at markets, okay? I said, hey, I want to invest in real estate, and I want to do it for the long term. I want to buy and hold because I want to be financially secure down the line. And I want to be financially secure down the line because if I know I'm financially secure down the line, I'm probably a better human today. Really? Okay. So then I say, where am I going to invest and feel confident that the investment will be strong 20 years from now? So let's pick on some markets.
Yeah.
Okay. If I ask you, Tony, do you think that real estate in Denver 20 years from now will be worth more, even just a nickel more? I'm not saying how much. It'll be worth more or worth less 20 years from now. What's your answer?
Yeah, I'm fairly confident it's going to be worth more.
Fairly confident, like 90%?
Yeah.
Like way up there, right?
Yeah.
Okay. And now I'm going to pick on a market that I'm not so sure about. Let's say I ask you Memphis, Tennessee. And I'm sorry if anybody's from Memphis. I don't know Memphis very well. I'm just guessing at it. I read about it a little bit. What about 20 years from now in Memphis? Do you think it's going to be worth more or less?
It may be worth more. My confidence score is a little bit lower.
Yeah, like a coin flip.
Yeah, it's probably a coin flip.
Great. And I was a student of Detroit. One of the things we did after the great financial collapse is we went out and bought a lot of property in Detroit, hundreds and hundreds of apartment units in Detroit. And in buying in Detroit, what I was doing was buying at the very bottom of the market. And once I got into it, I was like, what happened here? Why am I able to buy an apartment unit that's $4,000 per unit? Well, the reason why is because people left the city.
Yeah.
Fundamentally, they had a great exodus of people leaving the city. And so when we look at a 20-year market, what we're asking ourselves about are, do people move to the city? Do they have jobs? Do those wages increase or decrease? Is there high crime? 20 years from now, that's an indication of the schools. Are the schools good or bad? Is the city making great decisions for the long term for the infrastructure of the city? I mean, looking at Denver, I'm a Denver native, and so I can remember vividly when we chose to shut down what was at the time Stapleton Airport and start up Denver International Airport, and everybody kind of thought it was crazy for how expensive it was.
Yeah.
Well, that was a 20 or 40 or 100-year style decision that the city of Denver said, we're going to invest in this. And now I think it's the 6th busiest airport in the world.
Yeah.
Or 3rd or 4th in the country.
Yeah.
And that is an economic impetus that says, wow, this is infrastructure that's going to lead to a 20-year vision. And if I believe I'm investing in a market that has a 20-year trajectory that is going to be positive, and I feel very confident about it, then it checks the box. If I'm uncertain on it, if it's a coin flip, if I'm negative on it, I kill that market off the rip. It's gone.
Yeah.
And people come to me all the time and they say, hey, I can buy a rental property in Ohio and get more rents for the purchase price, because that's a relative. I buy the house for $200 and I can rent it for $1,500.
Right.
Okay, that's a ratio versus buying in Denver, my $400,000 house only rents for $2,500. It's not a doubling. And they say I can get more rents. Well, I always come back and say, is it going to appreciate? Because there's a reason why that home in Ohio is only worth $200,000 and not $400,000.
Right.
It hasn't appreciated over all these years. So that's the question that I'm trying to ask myself first.
Yeah. Do people want to live there?
That's right. Do people want to live there?
Do people want to live there?
Yeah. What are the migration patterns?
And even in that analysis, as we've matured, we're looking at things like the employment base. How many employers are there? What type of employment is being offered?
How diversified is it?
We just had a conversation yesterday about North Aurora.
Yeah.
How much has North Aurora changed in the last 15 years?
It's been incredible because of, and this is part of the Atlas investment thesis that we're going to get to. Now we're getting into the submarket, but it's changed a lot in North Aurora because of the Anschutz Medical Center.
That's right.
And so we're going way, way, way down the vortex to determine whether or not a market is viable or not, inclusive of the city and municipal and state governance. Because there's some places, and I'm picking on places, I'll pick on Detroit again. Detroit was known for a long time for corruption in its governance. That's not a good sign for a 20-year market.
That's right.
Yeah.
All right, well, in the interest of time,
Yes.
should we keep going?
Why not?
All right. Point number 2, buy in the path of development. We kind of stepped into that when we started talking about Fitzsimmons and Anschutz.
Yeah.
So talk more about path of development.
So we've decided that we like Colorado because it's a 20-year market.
Yeah.
And maybe more specifically, let's say that we decided that we believe in the Denver metro area.
Yeah.
In the Denver metro area, we all know the ring, the 470 ring. If you live in Denver, we know what that kind of looks like in terms of the cities and the counties that encompass it. Well, Colorado over the last 50 years has appreciated at about 5% per year. So that's standard appreciation. And when you hear people say the United States appreciates its real estate at about 4% or 3.5%, that's a very general comment. 5% in Colorado is a lot better than the average.
That's right.
In some places they're at 2-3%, and that speaks to the 20-year vision. But this path of development comment is, okay, I've picked Denver Metro. Now, how well do I know the city to understand how it's breathing and contracting inside of the city? And a good example on this is in 2008, 10, 12, I was a big buyer in the Highlands neighborhood of Denver. Not everybody understands Denver, so I'll pick on this a little bit. You had downtown Denver, which was very, very vibrant. And I said, gosh, that's really vibrant, but it's too expensive for me to go buy a good rental property for the buy and hold. So what is the next circle around the known circle? Where people might say, I want to live close to downtown and have those amenities. I can't afford it, and I need to be in this little pocket or that little pocket. And the Highlands neighborhood in Denver was to the west of downtown Denver. And I said, geez, if you just hop across the highway from downtown to Highlands, a comparable home is selling for, at that time, $150,000 instead of $400,000. And the living experience isn't all that different. And so I sort of said, maybe there's a little path of development. Maybe there's a little appreciation story here that the migration patterns inside the city are favoring this little pocket a little bit. And then you go deeper and you say, I'm going to go spend some time there and hang out there. Is there a cool restaurant? Is there a cool place to go hang out? The old adage of what are the artists doing? A lot of the arts and the creativity were coming from there. And I said, oh, there's kind of a little bit of a story here. Maybe I need to buy into this because I think that it will grow with the city. I'll get my 5% appreciation just like the city has gotten over the last 50 years. But if I choose this path of development right, I might get a little bit better than 5%. I might get 6, 7%. And so linking back to our story on North Aurora is east of Denver. And it's a little bit more on the flat side of the city. Flat side of the city has less supply constraints. We don't have mountains on the east side of the city in Denver, so there's less appreciation. So I need to find a new path of development story on the east side of the city.
That's right.
And this Anschutz Medical Center, this was 10, 15 years ago, they announced that they're going to put $5 billion into a new medical center. And I thought, wow, this is kind of a rough part of town at the time and pretty inexpensive housing. But what happens in a neighborhood if you sink $5 billion into it in infrastructure, and then that attracts personnel in that neighborhood, ranging from the nurse that's got a nice livable wage, all the way to the doctor that's making a really nice income.
Right.
But all of that is above the existing income, and they're going to want to live close to it. And then the light rail's coming in, and then all the retail and the hospitality and the hotels, because Tony's not feeling well. I want to stay close to him and be in the hotel and take care of him because he's my best friend and brother in life and in business. And so we bought into this thesis that was a path of development that we could buy into. And then right now, today, we're asking ourselves this question every day around the cities that we're involved in.
That's right.
You know, in Phoenix right now, one of our markets that we love, you have $100 billion being invested by Taiwan Semiconductor, and it's primarily on the north side of Phoenix.
Right.
Well, $100 billion investment, I think that's going to do something to the path of development on the north side of Phoenix.
Yeah.
On the southeast side of Phoenix and Mesa, you have several data centers that are coming in from Amazon Web Services and all the suspects for billions and billions of dollars. What does that do for the path of development? And then you're always comparing that path of development to some of the difficulties of those neighborhoods.
That's right.
When I was buying into the northern part of North Aurora, the school system in that area was very bad. And so I had a merit on one side for the Anschutz Medical Center and a demerit for the school system. And I said, is the school system going to change? And that was a leap of faith based on the investment.
That's right.
And when that happened in the Highlands, I said, is the school system going to change? And it did. It did happen. The school system has grown and gotten better. And so we're always asking that question of where the city is growing and breathing and detracting. And there's been other areas of the city where I've said, you know what? This picture is fully baked. We've seen all the appreciation that we can see. It might be time to move off of this one because the city is hurting in this area and it's actually getting a little bit worse.
Yeah.
So building off our original thesis, if I hit the 20-year market right, I'm getting 4 or 5% appreciation because I'm going to hit that US average.
Yeah.
If I hit the path of development right, I'm probably going to add another 2, 3, 4, 5, 6% of annual appreciation every year on my asset. And now I'm really starting to hit the ball out of the park.
That's right. That's right. And I think, Phoenix is a great example. A decade ago, we might have said, we don't really like Phoenix.
Yeah.
And we didn't like Phoenix for a couple of reasons, right? The employment base wasn't quite what we wanted to see. It's a pancake of a city. It's just this massive, sprawling metroplex. But not being too beholden to our own conviction, we're always looking at the data.
That's right.
And the data shifted with Phoenix, right? You had the migration out of California into Arizona. You have a landlord-friendly environment. You have these investments you're talking about. To where a few years ago, we looked at it again and said, hey, we were right on Phoenix. We want to stay right on Phoenix, which means we have to change our opinion.
That's right. All the time it's changing. I used to give Nevada the hardest time because it was an economy that was solely predicated on gaming.
Yeah.
And my fear was that gaming economy was going to become weaker as we legalize gaming more broadly across the country, and that's begun to happen.
Yeah.
But Nevada has also diversified its economy. It also has benefited from good governance and a tax structure that attracts people and net in-migration. And so all those data points are continual.
Yeah, and we operate hundreds of doors in the Vegas metro.
That's right.
And it's one of the best performing markets that we operate in today.
Yeah, that's right.
It's really interesting. All right, number 3, it needs to cash flow, Ryan.
Indeed. So one of the lessons that we learned coming out of the 2008 crisis was that there were a ton of people that owned amazing real estate. Prime main real estate that was worth a lot of money actually, and was going to continue to grow and be worth more money. But the real estate that they owned had no cash flow. And so the aha moment that I had that we had as a company was, okay, we got this chart, and over 20 years, the price is going to do this. But it's not going to be a straight line.
That's right.
Over a 20-year period, it's going to be an up and down line. And in those downs, sometimes you kind of think it's only going to go down.
That's right.
Let's go back to the original property we talked about.
Yeah.
You know, my property that I bought for $175,000, it went down to $75,000. And in that moment, had I been fixated on the value of the property, I would have sold and I would have lost a lot of money.
Yep.
Instead, because of cash flow, I was able to hang in the game. And I think cash flow is amazing when it gets to actually be income, and it's a yield that I get to get every month. But we don't buy these properties solely because they're going to provide us income. I'm not buying this real estate so I can quit my job, right?
Right.
This is kind of a supplement to my long-term financial security. And when things are going great, it is a nice supplement. I do get a little bit more income from it.
Right.
But as is the case right now with the interest rate environment, you know, many of our investors are on fixed rate interest. So they bought in 2020 or 15, and they're on a 3 or 4% mortgage. That's great.
Yeah.
Their cash flow is still fantastic, I'm sure.
That's right.
But for other folks, you had an adjustable rate mortgage. And a lot of banks don't keep on giving you fixed rate mortgages over time. They'll do it for you a few times, 5 times, 10 times. But then eventually they say, no more fixed rate mortgages for 30 years.
Yeah.
You're going to be on a floating rate mortgage. Well, when those interest rates floated, my cash flow in my portfolio went down.
That's right.
But it didn't go down so low that I was going to lose the property. And that's the key. The cash flow keeps you in the game for the 20-year period. And then when I pay off my debt 20 or 30 years from now, and I'm an old man, I don't feel old yet. When I'm an old man, then that cash flow is a really big deal because it turns into passive income. And when I'm 60, 70 years old, I'm going to want that passive income in my retirement just to pay my bills.
Yeah.
And at that point, the cash flow becomes my only income, and that's a great thing for it.
Yeah. So having positive cash flow allows you to weather whatever storm might come up, right?
That's right.
There are expenses to owning real estate. Right?
Very much so. And we've seen them be higher than they've ever been in the last 4 or 5 years.
That's right.
Yeah.
So managing toward cash flow, thinking about fixed rate debt,
Yeah.
or at least the ability to, you know, who anticipated 400 or 500 basis points of jump in debt
In
costs?
interest rates.
Yeah, I mean,
Yeah.
nobody anticipated.
That's right. Yeah.
And that's created some distress in the market.
Yeah, and I think that cash flow, the cash flow that we get from the rents on the property, it has to cover the debt. Everybody knows that. But one of the places that we're helpful as a company is it's not just the debt. It's also the property taxes, the property insurance, which is changing a lot right now because of what insurance has happened in our country over the last few years. The maintenance of the property and the property management. It's got to cover all those costs.
That's right.
Now you may choose to buy a property and manage it yourself.
Well, let's go to number 4.
Ah,
Professional property management. You know, this was not in the original investment thesis. Things have changed a little bit in the last several years, particularly in Colorado and some other states around owning investment real estate. Why did we add professional property management?
well, first off, I do want to give credit to folks that choose to be their own property manager. If you own a property or 3 properties and you want to be your own property manager, you can usually do a great job of it. But I also want to remind people that when they're choosing to be their own property manager, let's try to assess the value of our time too. You know, when you're doing a property management activity, and I can tell you this because we do a lot of property management, we employ a lot of property managers. What is kind of the value of that hourly wage that you're working on that? Now compare that to the value of the hourly wage that you get in your own job or other places that you could get value out of your time.
Mm-hmm.
So early on, I was my own property manager and it made a lot of sense. But as I made more money in my normal job, and as I had less time and I wanted to invest that time into my family, I realized that there was a nice trade between the time I invest into my own property as property manager and the time that I give it to somebody else to do because I can put it somewhere else. So that's the first point on this. Then the second point, and you're a real authority on this, is that it's become really hard to manage your own property and not fall into one of the many pitfalls of legislation and compliance that comes with doing it correctly.
That's right.
And I think that's what you were pointing at.
Yeah, I think if we look at, and if you're interested, we have a white paper on these legislative changes across all of our markets. Just shoot us a quick message and we'll send it out to you. But the last 5 years and the changes that we have seen just on the habitability laws. I mean, one of the big ones is just if you have to post a notice in the state of Colorado, the timing of those notices, how often they have to be posted, and the language in which they must be posted.
Yeah.
What a fascinating change. We didn't see that coming, right?
That's right.
And so we do think that professional property management can actually create kind of a liability shield.
Yeah.
So, and we talk about the costs of owning real estate. The liability of owning real estate isn't one we talk about very often.
Yeah.
And it's something that we deal with every day at Atlas.
We deal with it every day. I wish that we didn't have to be such a liability shield, but that is a part of it. I think the other thing that's beneficial about property management, and this is where the sponsor Atlas Real Estate gets to provide a plug, so we're highly biased. How many property management companies out there have the experience and currently own thousands of doors of real estate? And so finding really, really strong property management that can help you with your decisions today in the short term, okay? And most property managers are very short-term oriented. So you can find somebody that's short-term oriented and help your decisions today. But I think the trickier one is, how are you taking my needs into consideration for the long term? And how are we positioning this property to make sure that it gets its appreciation, that it stays in the path of development because of how we're maintaining it? Because sometimes we're so short-term oriented and we focus so much on the cash flow, let's say, that we're not really focused on winning the war. And the overall return on the real estate is going to be a blend of the cash flow as well as how it appreciates, but it's outweighted towards the appreciation if you get that right.
Yeah, that's exactly right.
Yeah.
Well, a few questions,
Yeah.
Ryan, that I want to make sure that we jump into.
Yeah.
First of all, is the Atlas thesis still relevant in today's market?
It's a phenomenal question. The very first thing to start with is where we began with, which is long-term orientation. If you think that you're going to buy a piece of real estate for 3 to 5 years, and in that 3 to 5 years you're going to want to sell out of it, we really want to take that into consideration and find out if it makes sense for you to buy that property. Aside from that ingredient, absolutely, this thesis still maintains. In fact, I don't really know of another place to invest my capital that has this strong of a risk profile with this strong of a return profile. And I measure them all the time. But I have control over my asset. It's tax advantaged. I have cash flow from it. I can own it for a very long period of time. If I pass away, there's benefits in how that passes away to the next generation and the tax advantage to them.
That's right.
And so a global perspective of investing says this is still a tremendous place to be.
Yeah, that's right. And when Ryan talks about the risk profile, think about owning real estate as it relates to owning treasury bonds, right? Which is like the risk-off bet.
Yeah.
And when you look at the cost of a mortgage-backed security against a treasury bond, that spread is really tight.
Yeah.
Which just shows you that investors view that risk as quite low.
Yeah.
And that's one way that we think about the risk profile.
I want to come back to one thing. Because interest rates are high right now, it is a game of patience.
Yes.
It's not like we can go outside and buy any property. It's, I want to do this. I'm going to put the wheels in motion. I'm going to get approved for my loan because most of us need a loan to do this. And then I'm going to be actively looking, but very, very patient. It may be a year or 2 or 3 years before all the stars align to meet this Atlas investment thesis. So it's not as though we're picking fish out of a barrel.
Yeah. Ryan, another interesting question that came up. How does this kind of entry of institutional capital into single family and build to rent in particular, how does that change the landscape for individual investors like me? Is it good or is it bad? How should we think about that?
I don't think that it's to think that it's good or bad. I think that there's so much happening in the market generally that it's difficult to point to that one element as good or bad. There are institutional owners of single family real estate and build for rent real estate that have entered into the U.S. market. Total, they own about 2 or 3% of all investment real estate, of rental real estate. Single family real estate, that's not a lot, 2 or 3%.
Of just investment real estate.
Just investment real estate.
Not owner occupied.
If you take all real estate, it's less than 1%.
Yeah.
So sometimes, we're making a mountain out of a molehill because it's a small percentage that they own. But actually, in some ways, I think that this can be looked at as a really positive feature because For example, right now, institutional owners are selling more homes to home buyers than they are buying new ones. And the reason why they're selling more homes to home buyers is because they realize they can sell that home to a home buyer and get a return on their investment. We need that right now in our marketplace. We don't have enough inventory right now for a healthy market. We need more inventory for a healthy market. So that's a feature in which they're going to be a seller at times when other people aren't going to be sellers, and we need that for liquidity, for fluidity in the market.
That's good. Got time for one more question, then we
Okay.
got to wrap up.
Okay.
And this one comes from one of our favorite investors we've worked with for many years, but a great question. Talk about how you view different sectors of residential real estate. So multifamily, mixed use, single family, mobile home, all that kind of stuff.
Great. In a broad stroke, I look at every sector of real estate, inclusive of office and retail and industrial, and then down the line for residential, mixed use and multifamily and mobile home and single family. When I take into account all of the risk factors and all of the fundamentals, I believe that single family real estate is the most resilient asset class. One, it's the backbone of the American economy. It is where we store our wealth as an American populace. Two, from a supply standpoint in the United States, we don't have enough single family housing.
Yeah, not even close.
Well, we need 10 million more homes. What is the figure?
Yeah, it's somewhere between 1 and 5 million, depending on who you ask.
Great, I'm glad I have him.
Yeah.
Between 1 and 5 million more homes to get to equilibrium in the amount of housing stock that we have. Versus if I pick on multifamily is overbuilt.
Yeah, that's right.
Massively overbuilt. And as a result, the rents are down, and that's vacancy and renewals, and it impacts collections, and it impacts value. And so I'm asking myself, where are the fundamentals great in all of these different asset classes? And do I believe that it will maintain for the very, very long term?
Yeah.
And single family housing has proven to be the store of wealth for most of our populace, and therefore the most resilient asset class.
It also offers exit optionality, right? So if I own a portfolio of single family homes, maybe I'm a really successful investor and I own 20 or 30 single family homes.
Yeah.
I could sell that as a portfolio.
That's right.
To an investor. And there may be a time where that makes sense based on what debt has done.
Yep.
But I can also sell those as individual assets, as a retail transaction to a home buyer who doesn't really care about a cap rate.
That's right.
They just care about having a house.
That's right. That's right.
Wow, this has been a great conversation. We are right at time.
Amazing.
Really fun to have this conversation with you.
Yeah.
If you want to learn more about investing in real estate, if you're an owner of real estate today, or if you want to become an owner of real estate, reach out to us. You can reach us at info@realatlas.com, and we would love to hear from you. Thanks for joining us today. Thanks, Ryan.
Tony,
Great
I
time.
love it.
Great
Next
time.
time we'll do this for 4 hours and 50 minutes.
Yeah, we're shooting for a 5-hour.
5 hour.
Yeah,
Long format. Lex
long format.
Friedman.
Yeah, Lex has got nothing on us.
He's got nothing on
Yeah.
us. We can fill some time.
I think we could. It's amazing we're ending on time.
But it's because of you.
Thanks, everybody. Have an amazing
Thank
day.
you.